Today, I want to talk about why the best investment strategy might be anti-investing. And I'm actually going to lean on my old buddy pal, Jim Collins, to help prove the point, because he studied companies that didn't just have great quarters, but had great decades. And I think what you're going to find overlaps a whole lot with investing. And it's going to be awesome on the Furlo Capital Real Estate Podcast, where we dive into the intricacies of passive real estate investing. And our mission is to equip people to anti-invest well, so that we can, what was this? Anti-invest well, oh my gosh, in properties and people, so that together we can build housing while improving our wealth. Nope, we can improve our wealth we can improve housing while building wealth. Whatever. You know exactly what I'm talking about. This is the anti-intro, apparently. I'm James, and this is my wife, Jessie.
Man,
every time it's so hard.
Every time. It is hard. You have like a flow, and then you mess with the flow.
I do, but it's
That's
worth
right.
it. It's worth it.
It is worth it. I do like the hook. I have no idea what anti-investing means.
Great question.
I mean, other than I know what anti means, and I know what investing means, so it's like don't invest. Don't invest investing.
Yes. It's more like, it's funny.
I'm against investing.
I had notes. It was funny. I was going through writing this all up, and I got partway through and went like, oh, I feel like I'm just like, there's a big overlap here with Jim Collins. And I was like, you know what? So I restructured my notes, and I actually got rid of that initial intro where I was explaining, what do I mean by anti-investing? So I didn't actually write it down. But it's the idea of by anti-investing, it means not doing the trendy types of things. It feels very opposite.
Okay.
And so as opposed to the goal, and maybe here's a way to say it, the goal shouldn't necessarily be, let me make as much money as I can. Okay. As fast as I can.
Yeah.
That's not, because that's usually like, that's a great investment. Look how much money he made and how fast. This is very different. And so, for example, the very first one that good old Jim talks about is he wants you to avoid the death line. Okay. So the concept is that in business, if you run out of cash, it's game over. And so in investing, that means that you also don't want to run out of cash. You don't want to have a permanent capital loss. You don't want to have to do a forced sale or have some sort of liquidity crisis or even hurt your reputation. And so those are the things that cause a death line that he was saying the goal is to avoid those things, because as long as you avoid it, you can keep playing the game, right? And that's the goal is to play the game, not necessarily, because there's no win, right? It just keeps kind of going. And so his quote is, you don't need to win big, you just can't die.
It seems kind of like a pessimistic view of investing, because it's like you want something that's going to be successful, that does make money. You don't just want to be avoiding a catastrophe. I guess.
Well,
I mean, yes, you do, but that is almost like, well,
I hear what you're saying. It's like, there's a quote when they talk about in football, a prevent defense prevents you from defending.
Right.
I think.
Yeah, it's like.
Yes. And yes, but I think it's like, you obviously do want to pay attention to the overall returns and what you're doing and get good deals. And we'll talk, I have other ones in there that dive deeper to make sure it's a quote good investment. But it really is about like, don't necessarily try to hit a home run. Just focus on hitting those singles and doubles. And,
all right.
And that's okay. So that's what he means by avoiding the death line. Don't do a speculative deal where you put all your money into it and you go, this could be it. And I got to roll a 6 to win. Like don't do those deals.
Yeah.
That's or
you don't want to leverage yourself
if you're doing
so
like
much
us, where we have
so much risk.
Exactly. We just recently got a new card game from the Oregon Trail card game. It's based off the original computer game, and it's just as
so
hard. My very first round, I had to forge a river card.
Yep.
And to forge to cross the river, you got to get an even number, so 2, 4, 6. But and if you don't, you have to keep going. But this card was special because it said if you roll a 1, you die. And guess what I rolled right out the gate? Very first round. I'm done. I was like, well,
bad.
Good game, everybody. Enjoy.
Good luck, family.
No, I sat there and I watched the rest of it. But that's the death line. So you don't those are bad investments.
Yeah.
Do an investment where it's like, because there were a bunch of other ones where it was like, you got to roll even to cross. If it's odd, you got to try again. Like those are fine.
Yeah.
Do those ones. but like,
but okay, that makes a lot more sense to me. Be aware of those deals that have
the critical
death
miss
risk. That you're like, all right, I'm just gonna risk this. I'm gonna go for it.
Yeah.
Like, don't do that.
Exactly.
Have some stability.
Yeah. Also related, by Collins, he talks about a concept called productive paranoia, right? And that's where like the best investors are quietly nervous, right? And it's not necessarily fear. It's not pessimism. Take that.
Yeah.
It's a constant awareness of what could go wrong and then preparing for it.
Yeah.
So this is where like the anti-investing behavior might be something where you just assume that conditions could get worse and you want to prepare for it. So even when markets, they feel calm and good, which they don't right now, but maybe they do, or when deals pencil out evenly, you guys go, well, what if expenses do skyrocket or my vacancy is a lot higher than I thought? And even when everyone else is optimistic, it's when you want to be like, okay, does this really make sense?
Yeah.
So it's not expecting disaster. It's just refusing to be surprised by it.
Yeah. Considering all the different possibilities.
Right. And so as a result, you're going to be a lot more conservative about those things. And you're going to test for things like higher rates, lower rents, longer hold periods, like I guess I said.
Sure.
And you might ask like what assumptions are carrying the most weight in whatever your investing model is.
Yeah.
And so you're not going to invest in as many things because you might be like, oh, man, I don't know. What if, right? And it's my job as the sponsor to tease some of those things out for you. And it's honestly like we had a couple deals where like we just didn't make as much as we wanted on it. And so I was like, you know what? Like I'm dialing back some of these assumptions that we had because the market has fundamentally shifted from where we were a year and a half ago. And so we're making those changes. And that's part of that productive paranoia where I'm like, you know what? It used to be you listed a property, the next day you had offers, 30 days later you closed. Like we're way beyond that now. And we actually have been modeling where it's like, well, maybe it sits for 30 days and then we have another 30 days to close. Like, nope, we're doubling those numbers now.
Whoa,
and I'm building that into the model. And you know, if it does better than that, awesome.
Great,
I'll take the win, but that's not what I'm walking into the assumption with. But that fundamentally means I'm now offering less money on properties, so I'm not getting as many deals. I'm anti-investing.
Yeah.
I'm okay with that.
Yeah, because overall it's a net win, a net positive.
I think so. I would rather my capital sit still and not do anything than lose money on it. Like, duh. But that's really hard.
Yeah, that is really hard
when it's just sitting there not placed.
Right.
Because it doesn't feel like it's working for you.
Yeah. Huh.
Next example of Collins is fire bullets and cannonballs. Oh, I love this one. And so the idea behind it was he talks about back in the olden days when they had ships, you would fire cannonballs at them. But it was like you first had to dial in, you had to calibrate the shot. And so what they would do is they would fire bullets first, get it calibrated, figure out, okay, here's how far it is, and then once they had it calibrated, then they would load up the cannonball and take down the ship. Because you could fire a lot of bullets really quick to quickly calibrate, whereas cannonballs, again, they're slow and expensive. The same thing's going to be true for your capital. So you want to figure out ways to test cheaply, learn fast, and only scale when it's validated. So you might start with a smaller initial allocation, right? You're only doing $50,000. You're not going all in on the $250,000, something like that. You watch how sponsors behave after they close with that. And then you pay attention during the boring quarters, not just the exciting ones. And so that's, and then once you're like, okay, this feels good.
Yeah.
Then you go all in now that you've mitigated some of that risk. And quote here was, most investors fire cannonballs emotionally after seeing other people succeed, which is the scary part.
Yeah, I could see an investor getting excited.
Yeah.
And just being like, oh my gosh, crazy deals. I got to get out there. I got to get in there. And if they don't,
I'll be honest, like that's
and
part of what I do, right? I'm
right.
Like, get in on this one. This is the one. I mean, I try to be pretty straightforward with it, but I'm also like,
sure.
I'm a slight hype man.
Yeah. Well, there's some sales involved in it, and you do need to build the hype. Need to get people on board.
But I also I do the other stuff. So when it's a good deal, I'm like, this is a good deal.
You're willing. Yeah.
So this is going to, let's see, this one will air after we have funded our land development deal.
Okay.
And so I'm going to predict in the future where we bought a piece of land and we did the initial, we got all the plans done. We got all the permits done. We did the initial site work. We got temp power, all the stuff. And so it was to a point, I'm going to put this in past tense. It was to a point where we were ready to like do the foundation and start building. That was when we went for funding after we had figured out all the other math, got everything set up. Like timelines were no longer a guess. We're ready to rock. And so the way I did present it was like, guys, this is a good deal. I ran the numbers. And we know what the comps are because we actually had a couple that were relatively close by that sold. We know the numbers. And even then, they're debt people. So if the numbers aren't exactly what I want, our lenders will still make the same amount of money for it. And because we're going with a builder who has built this house multiple times, we know exactly the cost. We know exactly the timeline. Well, then, and we also know the plus or minuses there because like this is what they do. They build these kind of spec houses. So it's just like, we've mitigated a lot of the risks there and we know the numbers. And so, I get excited about it. Like, this is a good deal. You should go for it. And we're helping provide affordable housing so it meets our bigger goal. So anyways, but yeah, I hyped it up a little bit. I'm like, this is awesome. Get in.
Right.
And we only have so many slots. That's the other issue with doing those We'll put that in quotes.
Which, like you're saying,
smaller deals.
Someone, if it's their first time investing with you, they could still invest a smaller amount.
Totally.
And test it out and get to know you and be able to build that trust.
And there's other things that you can do too in terms of firing bullets, which is hop on the phone with me. Let's have a conversation. Listen to these podcasts, read my stuff, download my downloads. Right. And like, those are other
you're transparent,
very easy bullets.
All this information and knowing what people are getting into.
Previous investors. And, I mean, they'll tell you, James is amazing at this. He's okay at this. He could use improvement here. Yeah. And I usually get that feedback and I try to take it in. So, yeah.
Cool.
He talks about in his book, one of his books, I think it's great by choice, the idea of return on luck. It's very interesting. He goes into this whole thing about how there are luck events. Things just happen. Okay. And great companies, they are able to leverage the good luck into good stuff or minimize the bad luck. And then, the way he got into measuring it was very interesting. And he actually, he didn't want to include it initially, but eventually his fellow students, researchers, were like, dude, this is a thing. So super interesting. And so, he talks about everyone experiences good and bad luck. Great performers extract more upside from the good luck and limit the damage from bad luck. Thank you. I did. It's almost like I made this earlier. And, but here's what's really interesting is that oftentimes you got to be careful where a good outcome doesn't necessarily equal a good decision. And vice versa. A bad outcome doesn't necessarily mean it was a bad decision.
Okay.
And that's part of there's luck in there. It's one of the things that I've had to grapple with, which was we bought our very first investment in 2009. And we just so happened to have graduated in 2007, had good jobs that were, they were established enough so that when the bottom fell out, we could keep our jobs and we had enough savings that we could get in on a duplex from another company who was struggling. And then it was like, how many years was it later? 10 years later ish. Like we were looking at all the numbers and I was like, because of nothing we had done, the economy had gone up. And I was like, oh, we can 1031 this into an awesome warehouse property. Yeah. Like I didn't do anything magical there.
There was timing that you didn't control.
There was luck in the market. Like, and one could make the argument the housing market had dropped and people paying attention would be like, okay, is this the bottom? I don't know. Is this eventually going to come up? Yes. Yeah. And so you want, this is the time to invest. But I also wasn't intentional about it, if I'm honest. Like it was just, I finally had enough capital, so we went for it.
I don't like the word luck, but only because...
Okay, then you don't like what Jim Collins was saying, but keep going.
Well...
Way to disagree with a great man.
It's probably...
Yeah, what's your thought?
It's
like there's market forces versus...
Yeah, there's...
Individual...
I tend to just lean more on, yes, there are circumstances that are outside your control and they'll either shift positively or shift negatively. Yep. But you can be intentional on paying attention to those things and taking advantage of the timing. Yeah. And I get that, yes, there's happenstance sometimes. I don't know. I wouldn't call that luck, I guess. Okay. I would just call it it was fortunate timing. Like you didn't have control over that. And it happened to work out great. Like, which, okay, maybe it's just semantics.
I think it is.
Some people call that luck.
I think so.
I don't know.
I don't know. I would hit on semantics.
I don't know. I guess I don't want to get like spiritual or philosophical or whatever, but I'm going to, because I also believe that like we're stewards of what we're given.
Yeah.
And if we're generous with that and open-handed and like are praying and like in relationship with God about managing all of it, like he's going to bring blessing. And this is not prosperity gospel. Like you do the right thing and God blesses you. But I think that is there, And so it's like, yeah, the Lord knows like you can handle this. You're going to run with this. And yeah, I'm going to bless you during these different times. So it's like, I wouldn't call that luck. Like
it's, Collins, I actually know wouldn't agree with this quote because he addressed it, but I have heard the quote, luck is the intersection of preparedness and opportunity.
Sure.
And I think that's kind of,
that's
where you're headed, where
of my definition.
Correct.
Yeah.
And I think that's, and I think the other piece is that what I got from his books is it's not just the luck events. Like that's not it. It's avoiding the death line. It's being productively paranoid. It's firing bullets and cannonballs. Yeah. It's getting the right people on the bus and then finding seats. It's all the things, right? Yeah. It's the hedgehog concept. It's clock telling. It's all the things.
There is preparedness and taking advantage of opportunity. And there happens to be great things that happen sometimes.
And he goes, and this is more like it's a lever,
sure.
right? It is like these are more the macro things. They're the opportunities,
yeah.
or like the bad opportunities, right? Yeah. And it's if you're disciplined about all the other stuff, then when those things come along, luck events, opportunities, or disadvantages, you're prepared to either handle it well.
Yeah.
Either like, oh, I'm going to leverage this to the max, or I'm going to minimize what's going on. And I think that's a fair characterization. So but I do say for our investing, yeah, obviously we were wise about it and we kept rolling into it. And I paid attention to what was going on in the market. I didn't just sit on those properties.
Right.
And we did keep them well maintained and well rented so that when the time came to sell, we got top dollar for them. And so there were things that we did where we were able to highly leverage it.
Yeah.
And then I went and found another deal that just made sense, right? And so
but that you're right. The initial timing, it wasn't within our control at all. It just was lucky that we had the income, the investments were there.
A certain year, graduated a certain year. It's funny. Like
perfect timing.
Think about my brother, who's in a situation where he graduated 2 years later than me. So he graduated. Let's see. He graduated in 2009. Couldn't get a job.
Yeah.
Like at some point in time, he was working for our dad, helping out with him. He was working for Arby's because that was a summer job that he had. He did a bunch of internships. But what are you going to do in that situation? And I know with HP, when I first came in 2007, I was one of the youngest people there. They had over the rest of 2007 and 2008 and a lot of 2009, there were younger, I would see other waves of people who were younger than me, and almost all of them left. And by the end of 2009, I was again the youngest person, and I was that way for 4 or 5 years. And then all of a sudden I went, hey, they got young people again. Cool. And so I hit that cutoff just right where I had been there long enough that I had established, I had the experience where okay, we actually want to keep them on board as opposed to, not hiring anymore. So I had no control over that. That's just pure luck.
Yeah.
Which gave us the income to then, we went on vacations, but we then were very disciplined about our spending. At one point in time, we were saving 70% of our income, and it was to invest and do stuff. And so it's that was the combination of those two things together is what helped. And so I would say for high net worth individuals watching this, they've got the capital and the opportunity. Now the question, and they've made some wise decisions and have been disciplined up until this point.
Yeah.
And so for me, what I'm trying to communicate is like, hey, you got to watch out for these things. Don't get exuberant. Don't go chase after the highest IRR that you can find. Don't think that you always have to have your money placed. Even though velocity is important, and the faster you can get money moving, the better. But it's got to be moving in the right direction. It can't just be moving for the sake of moving, because then you might miss on this other stuff. And so that's where I think we can put it all together in this anti-investing playbook, which has 4 parts. First one, survival first, right? Preserve your capital. That's the important part.
Sure.
That's one of the nice parts about a lot of the short-term stuff we do. You're a lender. So like you get a guaranteed interest, and I personally guarantee it because I have the portfolio to back it up. And that one investment relative to the rest of my portfolio is small enough where I'm like, yeah, like I can handle it. You're not going to lose your capital. And worst case scenario, again, if I don't pay it back, like you can take over the property, all sorts of stuff there. Principle number 2 is that paranoia with a purpose, right? You want to build slack in, you want to preserve some liquidity, and you just remember cycles exist.
Yeah.
It's a thing. And the question is, where are we now in the cycle? A few weeks back, we talked about my economic predictions and where we're at. I was listening to another show today that was, everyone's talking about it at this point, and everyone has different opinions.
Yep.
So you want to pay attention to that. Just assume that at some point it's going to drop and you want to be ready for it. Anti-investing principle number 3, you just want to slowly scale, right? It's that fire bullets, watch behavior, figure it out, and then invest. It's okay to take your time. You don't have to be
Don't go all in
to the pain
right away.
all the time. Exactly.
Yep.
And then number 4 is just judge the process, not just the results. And that's the whole, don't keep in mind there's luck in what you're doing, and that's okay. But so somehow as best as you can, try to extract out the, ooh, yeah, I got lucky there. Despite what I did, I still made money or whatever. Right. So there's some questions that you can ask as you're going through it. The first one is, does this deal keep me clearly above the deadline? Where is my margin for error? I think that's a huge one, thinking about assumptions. When we do flips, I actually do a Monte Carlo simulation. So I explicitly try to model that out. What does this downside look like? And, like for example, when we look at comps, we list them all in there. Some are higher, some are lower. So we use that to create our bounds and go, okay, what does the low look like? What does the high look like? Where do they all fall?
Right.
And so we can, I built into the model a way to run all of those. And then at the same time,
kinda cool.
we look at our repair costs, and the software that we use gives us a range. I go, okay, here's the lower end, here's the higher end. We do, when we put in the final number, I don't just do the middle number.
Right.
I actually do the 3/4 average of it. It's like, I'm going to buy
that's
something
more conservative.
Higher. But then in this Monte Carlo simulation, I say like, okay, if it's really high, what's that number? And maybe we'll get lucky. If it's a low, what's that number? And then we also do it for the hold period, because that's the other big one where we've got our assumptions in there, and then I essentially just go, and if it's longer than I thought, what would that be? And the cool part about the Monte Carlo is then we run it 1,000 times, and it iterates within those bounds for each of them, all kind of randomly.
Yeah.
That gives us a distribution of saying, okay, here's where the most likely outcome is going to be, and then given our explicit assumptions, here's where we fall on that curve. Are we more or less conservative relative to the most likely outcome?
Interesting.
And so it's just it's a mathematical way for me to
very analytical way.
I know, right?
That.
I wanted to do it because I remember I learned about the Monte Carlo simulation. I was like, this is so cool.
How can I use this?
I first used it at HP when it was actually during the whole 2009 stuff. We had all sorts of questions about like what's going to happen with the business, and I was like,
what's the range? I don't know.
And so we were doing it for hardware shipments and all sorts of stuff, trying to build in these different simulations.
Looking at a ton of scenarios all at once.
Yeah.
Possible scenarios.
I was trying to figure it all out. So, so I build it in because I want to know what those are. And there are times where it's like, I'll go, ooh, we are being a little aggressive. So let me dial back some of those numbers, which again, usually just translates into a lower offer. Or what we'll try to do is we'll try to structure it where we'll say, okay, well, let's do some more seller financing, or we'll try the sub 2, and that we can get you a higher price because of the terms and the payments and blah, blah, blahs. Yeah. And so anyways, that's the games that we play. Where am I making assumptions? No. What am I assuming will never happen? It's just a good question to ask, right? What are those black swan events? And Am I mistaking recent success for skills? And then just final one, if this deal underperforms, do I lose money? Or do I lose options? Which is another interesting way of thinking about it. So again, like Jim Collins, he didn't just study the companies that had great quarters. They had great decades.
Yeah.
And so I think a lot of those lessons, especially for real estate, since it is a longer term thing, I think they translate really well and are worth remembering. So that's what I mean by anti-investing.
All right. I'll buy it.
Cool. It's just being a wise investor. I don't know. It's catchy.
Yeah.
What can I say? So there you go. Anti-investing. Glad you buy it.
Let's anti-invest.
So if you want to anti-invest with us, you can check us out at furlo.com. And there you can see previous deals that we've done. You can learn more about our investing thesis, what we're all about. And heck, if you already own a property and you're looking for a property manager, give us a call for that too. But yeah, that's where you can learn more about us. With that, thanks for listening. Have a great day.